regional markets are faring this morning. Asian stocks are in cautious trade after top US congressional leaders backed military action against Syria. In Japan, the Nikkei is moving in a narrow range after the dollar traded above the 99 yen mark overnight. Also weighing on the markets, better than expected US data, which suggests the economy may be strong enough for the Fed to begin scaling back its stimulus as early as this month. Meantime, down under, Australian shares are retreating from three-month highs. However, a modest rise in Wall Street and a rally in gold prices are tempering losses. And to talk more about stocks and investment strategies is Daryl Liew of financial group Reyl Singapore. He joins us from our city studio at OCBC Centre. Morning, Daryl. So we've been asking this morning, will a US-led military strike against Syria hurt the appetite for stocks globally?
I think everything depends on how long and what's the scope of the excursion. I think basically if you look at all the analysts right now, they basically expect that it's going to be a targeted and short event. So I don't think there's going to be a material impact on global stock markets. However, having said that, the geopolitical risk premium for oil, for example, has definitely increased. Not so much due to Syria's oil supplies, for example, but more on the contagion effect where potentially some of the neighbors could be sucked in. So that obviously will have an impact on some of the countries and some of the individual companies that obviously have oil importers.
Well, there have been some fairly sharp moves in equities because of the Syrian unrest. Do you think Wall Street is going to stop short of a 10% decline there?
Well, it's tough to state a precise level. And I think the Syrian crisis right now is just one of many issues on the minds of investors. Tapering, of course, is topmost of that as well. But I would say that if Wall Street does pull back by let's say 10%, I think a number of investors, including ourselves, would be inclined to actually increase our exposure to US equities.
Well, we've seen some positive economic data out just in the last couple of days out of the US, but do you think the August jobs report is going to prove decisive in determining whether the US economy is strong enough for the Fed to dial back its bond purchases in mid-September?
Well, in my opinion, I think the FOMC have effectively made up their mind already. I do expect tapering to happen this month, unless we see a substantial deterioration in the numbers, which I don't think is likely, because when we look at it, fundamentally the US economy is definitely showing signs of recovery. I do expect them to start the tapering process and remove this overhang of uncertainty on the market.
Has the Fed bond purchase program helped the real economy beyond pushing financial assets higher, in your opinion?
Well, it's not just my opinion on this, but I think a couple of economists from the FOMC, one of the divisions, have actually done some research on this precise question, and I think their findings are mixed. They basically suggest that the impact on QE and bond buying on the underlying economy is minimal. In fact, what has proven to be a bigger positive for the underlying economy has been the Fed's guidance on interest rates. So I would say that the QE impact has been, it hasn't really worked so far.
All right, what about Europe after a few years of sovereign debt doldrums? Do you think it's suddenly become a hotspot for investors?
Well, I mean, the positive thing coming out from Europe over the past couple of weeks is that it's out of a technical recession, and I think a lot of international investors have been underweight European equities for a long time, because of the sovereign debt crisis and all the risks that everybody's aware of. However, with the slight improvement in the economic numbers coming out from Europe, I think a number of investors are now reducing their underweight to Europe. And I think with the US markets outperforming, people are taking profits on the US markets. And because emerging markets people are still concerned about, so money has been being channeled into Europe over the past couple of weeks.
Emerging markets have already seen 14 weeks of consecutive capital outflow. Are we seeing a new financial crisis unfolding, possibly?
Well, I've been monitoring the fund flows quite closely, and I thought that July we saw a bit of stabilization of the outflows. There was even some weeks where we saw a positive inflow into emerging markets. However, the outflows continued in August again. And I think all this are just concerns, people going into risk-off mode. Because I think when you look at it, fundamentally, a lot of emerging markets and Asian countries included are in a lot better shape than they were, let's say, compared to '97, where a lot of countries had fixed exchange regimes, for example. But I think if you look at this fundamental argument, if people are positive on the US and now increasingly more positive on Europe, I find it hard to envisage a scenario where emerging markets and Asia will underperform, because if US is doing okay and Europe is picking up, then I'm quite sure Asia and the rest of the emerging markets will pick up as well. So I'm not as negative as a number of pessimists out there on emerging markets in Asia.
And do you expect some upside surprises to China's growth in the coming months after China's factory activity shifted from contraction to expansion?
Well, I think everything really depends on what's your base case scenario. I think some of the pessimists out there on China were expecting, 7%, less than 7% growth. I think we're going to see GDP growth exceeding 7%. Basically, all these numbers coming out, the slightly more positive numbers coming out from China, is one that I've already predicted and expected. So it's not something that comes as a surprise to me. But I think for a number of the pessimists out there, the numbers are coming in. It's a bit more reassuring evidence that the Chinese economy is not going to plunge off a cliff.
Just one last question for you then, Daryl. India's manufacturing shrank in August for the first time in over 4 years. What's your view on investing in Indian assets now?
That's a tough question. I would generally advise to stay away from Indian assets at the moment because, notwithstanding what I said about my view on emerging markets and Asia, I think investors are now becoming a lot more discerning as to where they're going to be allocating their money. And the topmost concern now are twin deficit countries, meaning to say countries that are running both a fiscal as well as a current account deficit. Indonesia as well as India are the two countries that are running twin deficits, and those are the ones that will likely continue to see outflows until they stabilize their economic conditions.
All right. Well, thanks very much indeed for that, Daryl. That was Daryl Liew of Reyl Singapore, and that's a wrap from me for now. Back over to Steve.
All right. Thanks all.